Most traders lose money because they overcomplicate everything. But in this video, I'm going to show you the exact strategy that I personally use to pass evals and take trades like these. But before I show you that, I'm going to go over my trading journal to show you guys that I have proof and I'm knowledgeable. Alright, I'm in Notion right now. This is my trading journal. I started up this trading journal in November of 25. I've had a few before that. I've been trading for about a year and a half with journals. But yeah, this is my journal. I took a big break in this area, but there's probably about 40-50 trades consecutively in this journal. I got screenshots for everyone. This is a win, for example. And then this is a loss, for example. But yeah, that's the journal. That's to show you guys that I'm not capping. I do know what I'm talking about. I have some proof. With that being said, let's get into talking about the actual strategy now. Alright, so in this video, I'll be explaining my strategy, when to execute, where to put your take profit and stop loss, what confluences to use, and how to manage your account size so that you don't blow your accounts every single time you take a trade. PSA, if you're watching this video, you should, I highly recommend you watch TJR's Bootcamp and his Path to Profitability series. Otherwise, you won't be able to understand any of the confluences I'm talking about, and you won't be able to get a grasp on the strategy. So if you haven't already done that, or you don't know what modern ICT confluences are, then I highly suggest you go and watch those two series / bootcamps. But yeah, with that being said, let's get into the charts. Okay, so my strategy revolves around liquidity and new money entering the market, okay? These things all create volatility and price movement, which we want to make money off of the trades that we take. Because the end goal is to predict where price is going to move with high accuracy, okay? That is the end goal. So the first thing I do whenever I am about to start a trading day is I find my daily bias, and that's pretty simple. We have two ways of doing that. First thing we do is we go into the 1 hour time frame or any other high time frame, and we just look at where we're moving. Like, for example, right now we're moving down. Sometimes we could be moving up like this. That's an uptrend. And then sometimes we could be ranging and just like consolidating a little area. But yeah, currently we're in a downtrend. So my bias for today is probably going to be bullish. We're going to go back down to the 30-minute. I'll show you the other way that I like to do this. The second way here is I just look at where all of our low resistance draws on liquidity are. So low resistance draws on liquidity are areas of liquidity that have low resistance to being swept. That could be like close highs or lows in the market. For example, like pretty much all of this is low resistance draws because these are all pretty easy to hit. Like, I could mark these out for days. Got here, got here, got here, got here. So many low resistance draws on liquidity. But the way I like to do this on a trading day, at least, is I'll mark out London session, Asia session, and previous day session, New York session, and then I'm just gonna mark out the highs and lows of each one of these that are unswept, and that'll help us find our low resistance draws. This is previous day highs, previous day lows got swept. This is a 30-minute draw. Asia highs, Asia lows got swept. London highs, and then London lows, and then this is a low resistance draw right here. That's a low resistance draw right there, 30 minutes. And then that's a final 30-minute low resistance draw. Oh, there's one more up here. Yeah, so I mean, it didn't end up happening, but we are very bullish for today. Draw wise. I mean, we're in a huge downtrend. So like, yeah, but we don't I don't know what Nasdaq's doing. We don't have anywhere to go farther down except for like maybe like these freaking lows from 4 months ago in September. But other than that, we don't really have any much like farther down to go. Yeah, so we have a few steps here for our strategy. Let's go over step 1. Step 1 is high time frame liquidity sweep. This is very important. What do I mean by high time frame liquidity sweep? So what we want is, so let's just say we have our trend, and then we have market open right there. Okay, our low resistance draws are here, here, here. Okay, and before we can continue to go down and hit our low resistance draws, what do we need to do? We need to sweep our liquidity. What do I mean by that? We come up and we take out this high before continuing down to get to the rest of our draws. And I want to see this on high time frames. So 30 minute, 15 minute, 1 hour. Okay, so on Friday, we took out this 15-minute high right there. With this market open candle, we took out that 15-minute high. So we have our high time frame liquidity sweep. Now we're gonna move on to step 2, which is a 5-minute confirmation confluence. Confirmation confluence is anything from an inverse value gap to break of structure to an SMT divergence. Those are our 5-minute confirmation confluences. We like to see these to confirm that price is signaling a reversal, and it's going to continue with the trend of the liquidity sweep. So yeah, I think right here, what do we get? We gotta go to the 5-minute first, but as you can see, we do get this manipulation, and then we validated this manipulation by inversing this fair value gap right here. Yeah, so on the manipulation, we came up, we swept this higher here, we created a fair value gap, and then we validated our manipulation by inversing that fair value gap to the downside. And so we can move on to step 3 now. There is one nuance here with step 2 that I want to add real quick. Call it 2B. But let's say that we get we kind of did here. Let's just say that we get a liquidity sweep before market open in pre-market or in London session. We want to wait for a 5-minute liquidity sweep. In market open. So if we see that we swap liquidity before market open on the high time frame, and market opens, we want to see a 5-minute liquidity sweep to confirm that we are indeed going to continue downwards, and we hadn't just manipulated there and then distributed in that session. So yeah, all right, now to step 3, which is continuation confluence. Alright, so when we look for a continuation confluence, we're looking for a couple things. The first thing we could be looking for is a fair value gap getting tapped into. Second thing is equilibrium. Third thing is a Fibonacci level getting hit. And then the fourth thing, only if we have 2B is an SMT divergence. If 2B SMT, that rhymes. As you can see here, we have this inverse value gap. We do end up tapping into it because we created so we manipulated, we inversed the fair value gap, and we also created fair value gap off this big displacement candle downwards, and we tapped into it. So step 3 we can check off, and then we'll move on to step 4, which is a 1 minute confluence. This is the same as above, except I don't like to use SMT divergences on such low time frames because I think they're pretty inconsistent and not very trustworthy. But yeah, so we see that we have this fair value gap get created right here off the tap into that primary fair value gap, and we inverse it off this candle right here. So we can indeed say that we had our 1 minute confirmation confluence, and then step 5 is to execute. What do I mean by execute? I mean place your buy order, place your sell order, in this case sell order, and what we want to do for our stop loss is place it above the wick of the gap creating candle. So if we created a gap off this candle right here, we want to place our stop loss above that wick, and then our take profit is just other draws and liquidity, which would be here, and then I'd probably only set it there because we don't have any other primary draws. So yeah, that's a little 1 to 1.75 risk reward trade. We did end up banking that. I think I did take that on Friday. So yeah, that's what we got for our strategy. Now I'm going to go over some examples to help you guys kind of grasp this a little bit easier. First I got to remove all this clutter from the chart. Alright, let's look at Wednesday, and let's go Tuesday. Alright, so we're on the 30-minute. Let's mark out our draws. Asian and London. Alright, let's get the draws marked out. Previous day highs, previous day lows got swept. 30-minute high, Asia highs, oh they already got swept actually. London highs, Asia lows, London lows, 30-minute low, or 30-minute high. Okay, so let's get our strategy pulled down here. Market opens. What do we see happen here? We sweep out these Asian lows right here, and we sweep out Asian and London lows. So we have our high time frame liquidity sweep right there. We're gonna go down to the 5-minute. There we go. All right, we're on the 5-minute. Now we're going to look for a confirmation confluence. So what do we have here? We have a fair value gap, and lo and behold, we inverse it. So the inverse is right here. So that is step 2 checked off. Now let's go into step 3, which is look for a fair value gap to get tapped into, and we actually see we have a fair value gap right here that gets tapped into as well as we have equilibrium get hit. Yep. So that's step 3. We'll move on to the 1-minute. So after we hit equilibrium, I'll probably wait to see a inverse of either this gap or this gap. This break of structure is too minuscule to count it as a confirmation confluence, and then we actually do inverse this gap right here. So I would probably enter off this. I'd take longs here. I would set my stop below the below the wick of the gap creating candle, which is like right there, and then we'll go TP at this high for partials, and then we'll go this high for more partials, and finally we'll take this high for our last partials. So that's a, what is that? It's a 1 to 2.5 RR trade. So yeah, let's see. I think we hit all of them. Yep, we did hit all of the. Well, we did hit all of the levels. So yeah, all right. Let's get into the next example. Let's delete all this stuff. All right, I think I'm gonna go look at. Okay, so we're gonna take a look at our last example here. I think we'll take a look at Thursday. I'll go Monday. Gee, Monday wasn't the greatest day for trading. We had this Drake candle from a Trump tweet, per usual. Drake candle. Let's take a look here. It's when market opens. It's London. There we go. Asian and previous day. All right. So let's see here. Let's mark out our draws. So we have. We have this low, and we have this low that are unswept, and I guess we have this high. Everything else is swept already. Oh, I guess we do have this high. And this high. Okay. So these are our draws. Let's go on the 15-minute. Let's see what happens. Off market open. What do we do? So guys, so to start off, when you have a big Drake candle like this, or just any displacement candle above like 300 points, 400 points, it'll create, usually it'll create a fair value gap. And when you have a fair value gap like this, you have to assume that it's going to get tapped into, because price can't really move if there's all these unfilled orders just sitting here. So I would be bullish for, or not bullish, I would be bearish for today because we have a gap there. I would expect us to tap into the gap. But yeah, let's see. So on the 15-minute time frame, we do sweep these highs right here, indicating that we are indeed bearish for the day. And then that checks off step 1. Step 2, we inverse that gap right there. It's a pretty small gap. I would actually wait for. I think, yeah, I'd probably, yeah, I'd wait for this gap to inverse, which we end up getting right there. And then we do actually, oh no, those are just equal. So we end up resweeping, or not resweeping, we end up inversing that final gap. So we got our, so we inversed the first gap. Then I would probably look for a retracement, which we did get. We tapped into equilibrium right there. And then we inverse the final gap right here. I know that goes against like the look for the 1 minute, but the 5 minute holds more power than the 1 minute anyways, so I'd probably enter off that inverse. I'd enter off this inverse right here, just to be safe, you know. And I'd set my stops above, probably above these highs. And then I would set my take profits all the way down at this low, and then break even would be here. So that's a 1 to 2 RR, and we do end up hitting both of our TPs. So yeah, that's it for the strategy for today. Hope you all enjoyed the video. If this helped you out, please like and subscribe. One thing I forgot to mention is risk management is the most important part of trading, and so you need to be risking 1 to 2% of your account maximum per trade. Also, always trade micros. Don't be trading minis unless you have like a 100K, 200K account, because you can't get out of trades as easily, and you can't manage profits as easily. But yeah, if this helped you, leave a like, subscribe. Have a good day.